Here's a bold statement. I don't believe Ethereum will ever revisit its old pre-merge lows. The days of triple-digit Ethereum are behind us. While many are busy speculating how high Ethereum could go, the smarter and often overlooked question is the opposite. What's the absolute worst-case scenario from here? This video, I'll walk you through 4 independent perspectives: long-term trend models, statistical extremes, and Ethereum's unique cycle behavior, to build a data-driven estimate of Ethereum's real flow. When multiple signals converge, it gives a stronger, more reliable estimate than staring at one chart alone. No hopium, no guesswork, just math, history, and probability. We'll also use visual clues and heat maps to make the concepts more intuitive, so we can follow the math without needing a PhD in statistics. Let's dive in. The first perspective is the 200-week moving average, a classic long-term trend anchor. This line smooths weekly Ethereum closes over almost 4 years, filtering out noise and highlighting the structural trend. Historically, whenever Ethereum has dipped towards this line, it has acted like a psychological and technical flaw, where panic selling often gives way to accumulation. Notice the heat map: cold blue when price hacks the moving average, hot red when it stretches far above. It's a visual representation of overextension relative to the long-term trend. Importantly, because Ethereum's adoption and liquidity have grown steadily, today's 200-week moving average sits well above prior cycle lows. That alone makes a return to triple-digit Ethereum highly improbable. Ethereum's growth is not linear, it's exponential. That's why logarithmic growth bands are critical. A log regression model plots Ethereum's long-term trajectory, including upper, central, and lower bands. The lower bands act like a structural flaw, reflecting fair value based on historical growth and adoption trends. Historically, this lower band tracked the market bottom in the past cycles. In early cycles, it hovered in the low hundreds, while today it's in the multi-thousand range. Even in a brutal retracement, Ethereum would likely only touch this lower band, still far above old lows. This model is particularly helpful in cycles with extreme volatility, because it adjusts the flow upward as the nominal price level rises, keeping your perspective realistic. Next, let's take a probabilistic perspective using z-score bands. A z-score measures how far the current price is from its mean, relative to the standard deviation. In simple terms, it shows how extreme a move is compared to historical volatility. We use plus minus 1, 2, and 3 sigma bands to identify extreme zones. Historically, Ethereum bottoms have formed when price hits -1 or -2 sigma, signaling panic and capitulation. Because Ethereum's volatility has decreased over time, the same sigma levels now correspond to much higher prices than in previous cycles. So even a panic scenario hitting a -2 sigma level would still place Ethereum well above past lows, reflecting a structurally stronger market. Finally, let's stress test Ethereum using historical drawdowns. Ethereum has historically experienced drawdowns as deep as 90%, but 2 factors have changed: adoption levels and supply dynamics. Let's run scenarios. If Ethereum peaks at 6,000, a 65% drawdown, similar to past cycles, would land near $2,100. A 70% drawdown would hit roughly $1,800. Even a catastrophic 80% drawdown scenario still positions Ethereum in the low thousands. These scenarios are crucial because they help investors understand risk sizing and worst-case planning, not to predict exact bottoms. The math is straightforward. By modeling multiple peaks, you can see how resilient Ethereum's base has become. Let's combine all lenses. The 200-week moving average indicates a floor near $2,400. The logarithmic growth bands suggest $1,300. The z-score extremes imply $1,400. The cycle drawdown math gives $2,100. When we average these independent signals, the candidate flows converge into the $2,000 range. This convergence is powerful. Different methodologies, same conclusion. This approach mirrors scientific reasoning. Cross-checking results using multiple independent experiments increases confidence. Investors and traders can use this to establish risk parameters and avoid panic selling during volatility spikes. Of course, nothing is guaranteed. Some tail risks could drag Ethereum lower temporarily. A centralized exchange collapse might trigger forced selling. A global liquidity crisis could spark broader risk-off flows. Severe regulatory shocks could reprice Ethereum's risk premium. These are external shocks, not structural issues. Mathematical flaws and structural trends remain intact, giving investors a framework to differentiate temporary panic from real structural weakness. Here's the takeaway. Ethereum's long-term floor is no longer in the hundreds. It's in the thousands. Multiple independent metrics, moving averages, growth bands, Z-score extremes, and cycle drawdowns, all converge on that conclusion. This analysis is not a timing tool, but a risk framework. Knowing where the floor likely sits helps investors size positions and avoid panic. If you found this useful, subscribe to Sigma Quant. We focus on quantitative market research. Data first, hype second. Comment below, where do you see Ethereum's real floor? On which metric do you use the most? Thanks for watching. Check out our other analysis for more data-driven insights. See you next time.